The 35th edition of the CMO Survey is built on survey responses from 308 marketing leaders at for-profit U.S. companies, 97% of whom hold positions of VP level or higher. These findings arrive at a moment of notable economic stress, and the results reflect it, not just in the economic data, but in the patterns of behavior, investment, and strategic choices that run throughout the survey. I will discuss 6 key findings in this video. More than half of respondents report they are less optimistic than last quarter, and economic pessimism is at its highest level since the height of the pandemic in June of 2020. This negative outlook and its triggers are reshaping marketing priorities. To begin, tariffs are having a direct impact. Nearly half of companies have already raised prices or plan to do so this year. In response to this uncertainty, almost half of marketers are pulling back their targeting strategies to focus on increasing the loyalty of their existing customers rather than pursuing new ones, especially in new geographic markets. Growth spending is following a similar suit, with companies spending almost 60% of their budgets on market penetration strategies that focus on selling more of existing products and services to their existing customers. This inward orientation is a consistent theme across the 2026 findings. AI use in marketing has more than tripled since 2022, with generative AI growing especially fast. Companies project AI will account for more than half of marketing activities within 3 years, and the business case is strengthening. Measurable improvements in sales productivity, customer satisfaction, and marketing overhead costs have all risen year over year. Digital marketing's contributions to company performance have also improved meaningfully, with 3/4 of companies rating this impact as strong. At the same time, we see evidence that technology adoption is outpacing organizational readiness. No marketing technology activity scores above 5 on a 7-point performance scale. This includes key steps such as integrating marketing technologies into our customer funnel and generating ROI from marketing technologies, among others. And the barriers are decidedly organizational. Factors such as budget, integration, bandwidth, and talent dominate the explanation for these challenges. Companies will need to ensure that their investment in technology is matched with an investment in the capabilities needed to use it effectively. Marketing capabilities are rated as important to business success, averaging 5.9 on a 7-point scale, and companies overwhelmingly rely on building them through training and hiring as their primary approach. Yet training budgets have fallen steadily for years, now standing at just 3.8% of marketing spend, down from a pre-pandemic high of 5.8. And marketing headcount has also slowed sharply, declining more than 50% from last year's rate. It is perhaps not surprising then that the most commonly cited capability gap is not a missing skill, but inadequate resources, not enough people, time, and budget to make existing capabilities function effectively. Marketing's formal responsibilities have grown significantly since 2025, with notable increases in the management of revenue growth, public relations, and customer insight. Marketing leaders are also participating more frequently in board meetings. Yet the CMO-CFO partnership has barely moved in 4 years. It is rated just 4.5 on a 7-point scale for building the case in the management of marketing spending, and fewer than half of companies report that marketing and finance work together on growth projects. Marketers devote roughly twice as much time to managing the present compared to preparing for the future. And this has been the case every year since 2019. Pressure from CEOs, boards, and CFOs is reinforcing that short-term orientation. The predominant response to this pressure is a shift toward short-term impact over long-term gains, as well as a return to established strategies. Rather than investing in deeper customer insights, most marketers focus on developing stronger performance tracking as the primary way to demonstrate the value of marketing. Marketing budgets have fallen to their lowest levels in recent years, 9% of revenues and 9.6% of overall budgets. And overall spending grew just 1.7% over the prior 12 months. That's the weakest rate increase since 2021. When profits fall short of expectations, 53% of company executives focus on cutting expenses rather than investing in revenue growth. And that's up from 46% 1 year ago. When these cuts are made, marketing expenses are cut more frequently than any other expense category. This practice challenges other survey findings that the durability of marketing's impact on customers has grown meaningfully since 2022, increasing up to 6 months in duration. In another contradiction, although almost half of marketers cite building loyalty and retention among their existing customers as their primary strategic response to economic uncertainty, acquisition spending is now 26% larger than retention spending and growing, even as customer retention is outperforming customer acquisition in the performance data. Channel strategies are expanding meaningfully, with 57.6% of companies increasing the number of channels they use. Both digital and physical channel growth are occurring in parallel rather than as substitutes. Companies are adding digital channels, social selling channels, new face-to-face channels, and retail media. This broad-based expansion stands in contrast to the inward orientation visible in other parts of the survey findings, and suggests that marketers see the customer interface as a place worth investing, even in a cautious environment. I hope these findings are useful in your work. 3 reports, which are provided free of charge at cmosurvey.org, summarize these and other results from the 35th edition. The Highlights and Insights report shares key survey metrics and trends and insights over time. The Top-Line report offers an aggregate view of results, and the Firm and Industry Breakout report examines these results by company sector, headcount, and sales.